While most retail investors were distracted by flashing price charts and daily volatility, the real decision was made far away from the public eye, behind closed doors in Basel, Switzerland. There, the most powerful financial institution you've probably never heard of made a move that will reshape global markets. The Bank for International Settlements, known as the Central Bank of Central Banks, has officially pushed the Basel III Endgame rules into their final implementation phase. This is not speculation. This is not a rumor. This is a binding regulatory mandate, and it takes effect when markets open on Monday. They passed it quietly for a reason, because they know this changes everything. For decades, banks were allowed to treat paper gold and paper silver as if they were the real thing. Unallocated contracts, IOUs, promises, all counted as safe assets. That era ends now. Starting Monday, the illusion collapses. To understand why this matters, you need to understand how banks operate at the deepest level. Capital requirements. Under the old system, banks could hold massive positions in unallocated gold and silver and classify them as low risk. They could short the market aggressively without real consequences. Basel III changes that through a mechanism called the Net Stable Funding Ratio, or NSFR. Under the new rules, holding unallocated paper metal becomes expensive, inefficient, and dangerous. Short positions are penalized. Leverage is punished. Banks are now forced into a corner, either by real physical metal to back their positions, or exit the paper market entirely. This rule was designed to prevent another 2008-style collapse. But in doing so, regulators may have ignited something far bigger. They've lit the fuse under the precious metals market. For over 40 years, silver prices were suppressed through naked short selling and paper manipulation. That suppression relied on cheap leverage and regulatory loopholes. Basel III closes those loopholes. Institutions like JP Morgan and Citi can no longer sit on billions of dollars in short positions without holding massive amounts of capital against them. The cost of manipulation has exploded. The cost of carry has skyrocketed, and we're already seeing the effects. In overnight markets, banks have begun unwinding short positions to meet the Monday deadline. This is not speculative buying. This is forced buying, driven by regulatory compliance. And that kind of buying doesn't stop easily. The most bullish aspect of Basel III is the reclassification of gold, and by extension, silver. Gold is no longer treated as a risky commodity. It is now officially classified as a Tier 1 asset. That puts gold in the same category as cash and U.S. Treasuries. In other words, gold is now considered risk-free capital. This changes bank behavior completely. Instead of suppressing prices, banks are incentivized to accumulate physical metal to strengthen their balance sheets. They are shifting from sellers to hoarders. And once banks become buyers instead of sellers, price floors rise permanently. This explains the sudden liquidity vacuum we saw recently. Sell orders disappeared. Markets froze. That wasn't a glitch. Market makers stepped back because they knew this rule was coming. They pulled liquidity to recalibrate algorithms for the new Basel III reality. The strategy has changed from suppress the price to secure the asset. Industrial giants like Tesla, Samsung, and Apple understand this shift. They know that if banks stop flooding the market with paper silver, prices must rise to meet physical demand. That's why industrial buyers are panic buying. They're racing to lock in supply before banks absorb available inventory to satisfy regulatory requirements. It's a race, factories versus banks. And there isn't enough silver for both. China saw this coming. The Shanghai Gold Exchange has operated on a fully allocated, physical-only basis for years. China has already aligned with Basel III standards. The West is just now catching up. By passing these rules, Western regulators are quietly admitting something uncomfortable. The paper-based Western model failed. The physical-based Eastern model. 1. Paper derivatives are dangerous. Physical metal is real safety. So why should you care? Because while Basel III makes banks safer long-term, it weakens currencies in the process. To buy gold and silver, banks must sell dollars and treasuries. That puts downward pressure on fiat currencies. As gold and silver are revalued higher to meet Tier 1 standards, the purchasing power of the currencies backing them must fall. Gold rising is dollar devaluation by another name. If you hold unallocated silver at a bank, this rule is a serious risk. Unallocated metal is now a liability to banks. They are incentivized to close those accounts or cash clients out. Expect letters like this. We are discontinuing our precious metals program. Please accept this cash settlement. If you don't hold physical metal, you may be forced out at the worst possible moment. You won't hear about NSFR or Basel III on the nightly news. It's too technical, too boring. But this is the plumbing of the financial system. The media will talk about volatility, not the cause. The cause is a fundamental shift in how leverage is allowed to exist. The era of infinite leverage ended quietly. This is as significant as 1971, when Nixon closed the gold window. Back then, we moved away from metal. In 2026, we move back, slowly, bureaucratically, and quietly. Central bankers know the debt is unsustainable. They're preparing lifeboats, and those lifeboats are made of gold and silver. With manipulation becoming too costly, real price discovery can finally occur. Short-term volatility is inevitable as paper shorts unwind, but the long-term direction is set. Prices must rise until physical supply meets physical demand without paper dilution. That price is far higher than current levels. Because banks must hold more capital, they will lend less. Credit tightens. Mortgages become harder to get. Business loans dry up. Deflation in credit meets inflation in money printing. That's stagflation. And historically, silver thrives in stagflation. The smart move is alignment. If banks are forced to hold physical metal, you should too. If banks are exiting paper, you should exit paper. Do not fight regulation. The wind is blowing toward tangible assets. Basel III is active. The scramble has begun. Shorts are covering. Physical markets are tightening. This is not a conspiracy. It's a regulatory reset. The paper game is ending. The physical game is beginning. For decades, the LBMA exploited a loophole allowing unallocated gold to count as high-quality collateral. The same bar was leased multiple times. Basel III closes that door. Tier 1 assets must now be allocated and physically present. Fractional reserve bullion banking is dying. As London demands delivery, global vaults will drain at unprecedented speed. Derivatives depend on collateral. Better collateral means less leverage. That means forced deleveraging. Hedge funds that relied on cheap leverage to short silver will be wiped out. Sovereign wealth funds saw this years ago. They've been positioning quietly. Now that the rule is live, public allocations will follow. When trillion-dollar funds move just 1% into silver, the market breaks. Gold regains its role as money for central banks. Silver regains its role as money for the people. The gold-to-silver ratio will compress. We are witnessing stealth remonetization. Ironically, rules meant to stabilize banks may destabilize them short-term. Many banks don't have the metal they need. To comply, they must buy, pushing prices up against their own shorts. That's a doom loop. The Fed will likely print to bail them out. Inflation follows. Audits are coming. Vaults will be checked. Double-counted metal will be exposed. Some banks won't survive. Miners will sell directly to banks, bypassing retail entirely. Retail supply will vanish. This is a slow rollout, but markets price the future today. Smart money isn't waiting. By the time the full impact hits, silver will already be triple digits. Basel III forces honesty. Honest money means higher prices. The banks are buying. Nations are buying. The only question left is, are you?